Dear viewers, I have been sharing with you about how AI has taken over our day-to-day lives and whether it is emerging as a serious threat to the jobs out there, including to my field. The comments that I have received are both thoughtful and engaging. It is clear that the debate around AI and its impact are just getting started. Some of the fears seem to be coming true, with TCS, one of India's largest IT companies, laying off thousands of employees. AI is the theme of the decade, a trend that will have its fair share of upsides and downsides. And an interesting development is unfolding along. While AI hawks the spotlight, it is fueling another equally important theme, energy. It is a powerful undercurrent that is quietly driving the AI wave. Think about it. Training and using large language models and operating engines like ChatGPT or Gemini is energy guzzling. The infrastructure needed for AI, from chips to data centers, needs energy. Elon Musk, in his notoriously blunt style, has said that the next shortage will be electricity. They won't be able to find enough electricity to run all the chips. This surge in demand needs huge investment in generation, transmission, and storage infrastructure for power. There is a visible shift towards green energy. Energy, power, and electrification are closely tied to AI and emerging as some of the most promising themes for the decade. I have been looking for ways to play this theme in the market, and I've come across two interesting candidates: IndiGrid Infra Trust and Power Grid Infrastructure Investment Trust. Both focus on transmission infrastructure assets, offering a mix of predictable cash flows and potential for growth. For investors, this combination is appealing, especially when backed by the long-term tailwinds of rising power demand, electrification, and the energy needs of an AI economy. So why do InvITs exist in the first place? Well, infrastructure projects are capital heavy and take years to complete. This long gestation period means that they need patient, long-term capital. Banks do fund such projects, but there is a limit to how much they can support without running into their own asset liability mismatches. To protect themselves, banks often shorten loan durations, which creates pressure on the project to repay quickly, reducing its ability to service debt and leaving little surplus for other shareholders. InvITs provide a solution to this problem. They are designed to channel long-term capital into the infrastructure sector. An InvIT pulls together multiple infra assets under a single trust. These assets are typically housed under special purpose vehicles or SPVs, and the InvIT acquires them either through the capital raised from investors or through debt. This structure allows the original asset developer to effectively monetize the asset and redeploy funds into new projects. InvITs therefore facilitate continued infra investment in the country. But what makes them particularly interesting for investors? For starters, SEBI regulations mandate the following: that InvITs must distribute at least 90% of their distributable cash flows to investors. This makes them an attractive proposition for those seeking regular income or dividends. There are other layers of investor protection as well. To ensure discipline, InvITs have a leverage cap. They can take on debt up to 49% of their net asset value, although this can be increased to 70% if certain conditions are met. Publicly listed InvITs are also restricted in terms of how much they can invest in under-construction infra projects. This cap, set at 10%, helps to limit execution risk. Moreover, if an InvIT's net debt or payment obligations exceed 25% of the value of its assets, it must obtain a credit rating. These measures are designed to ensure a balance between growth and stability. Investors must also assess the underlying asset portfolio for its ability to generate steady cash flows and meet debt obligations. A diverse asset portfolio across geographies and asset classes reduces risk. One must also look at stability of cash flows, the growth potential embedded in existing contractual terms, the duration and cost of debt, and the trust's overall ability to manage costs effectively. All these are critical aspects when comparing one InvIT to another. Do note that InvITs are not risk-free. A potential rate hike could increase the cost of debt, limiting future acquisitions and growth. A weak pipeline of new assets could also limit expansion. Then there is a risk of regulatory tax changes, which could impact returns. Finally, the credibility and the track record of the sponsors backing these invests are crucial. Strong sponsors mean better corporate governance and more reliable execution. Now, do not take this as an investment recommendation, but given their participation in India's growth story while offering stable income, power invests do deserve to be studied further. Do you agree? Let me know in the comments section. Thank you for watching. Goodbye.